Welcome back to Talk Tickers. Today, we are training our lens on a quiet giant in the wealth management space. We're breaking down LPL Financial Holdings ticker LPLA, covering the fourth quarter of 2025.
And I know what you might be thinking. LPL Financial. It's not exactly the most exciting ticker. It's sort of the plumbing of the financial world. Not AI, not crypto. But if you came here looking for a boring financial services print, you actually came to the wrong place today. This one has layers.
It really does. It's got some drama, actually. So let's just establish the vibe immediately. The earnings dropped, the market digested them, and the stock reacted pretty positively. We saw it up about 2.16% in the aftermarket, trading around that $370 handle.
Right. It wasn't a euphoric moonshot, no confetti cannons going off or anything, but it was a very solid thumbs up from the street. And the volume was heavy. Over 1 million shares moved, which, that tells you the big institutions are paying attention.
But here's the hook, and this is what we're really going to spend our time unpacking today. This quarter is a classic case of scoreboard versus story. Because if you just look at the printed numbers, the scoreboard, they were fantastic, record-breaking even, but the market seems completely obsessed with a single future event, the massive integration of Commonwealth Financial Network.
That is the tension point right there.
Yeah.
You have these incredible fundamentals right now, and they're clashing with this execution risk in the future. It's like a star athlete who just played a perfect game, but everyone's just worried about whether they're going to sign the contract for next season.
That's a great way to put it.
So our mission today is to walk you through that clash. We're going to look at the record EPS. We're going to dissect why everyone is so nervous about advisor retention. And this is my favorite part. We're going to look at a hidden signal the CFO gave about buying back their own stock, maybe sooner than anyone expected.
I do love a good CFO Easter egg. But okay, before we get to the secrets, let's clear the deck with the results snapshot. What did the scoreboard actually say?
The scoreboard was green across the board. The headline number, adjusted earnings per share, came in at $5.23. Now, for context, the consensus estimate, what the average analyst thought they'd do, was only $4.92.
So that is a significant beat.
It is. And year over year, that represents a 23% increase in earnings.
23% earnings growth for a, quote, boring financial utility. That is nothing to sneeze at. And speaking of size, the asset numbers were just massive.
Staggering, really. Total assets ended the year at $2.4 trillion.
Wow.
That's up 36% from last year.
2.4 trillion. It's hard to even visualize that much money.
Well, think of it this way. That's roughly the GDP of Brazil. It's a colossal amount of retirement accounts, 401ks, and, rainy day funds just sitting on their platform.
Okay, and revenue?
Revenue hit $4.93 billion for the quarter. That's up 40% year over year.
But one thing that stood out to me was the new money coming in. Because asset growth can just come from the stock market going up, right? If the S&P 500 goes up, LPL's assets go up with it.
Exactly. That's just market beta. But what we want to look at is organic growth new clients, new advisors walking in the door. And even with all the noise we're about to talk about, organic net new assets in Q4 alone were $23 billion.
$23 billion in one quarter.
Which is a 4% annualized growth rate. So the immediate takeaway here is that on a fundamental basis, the engine is absolutely humming. The market looked past some of the macro choppiness to reward the beat.
Okay, so the engine is humming. Let's talk about the elephant in the room, or maybe the Commonwealth in the room. This acquisition is the largest deal in LPL history, bringing over roughly 3,000 advisors. It is the central strategic lift for 2026. So why is everyone so nervous about it?
It all comes down to one word: retention. When you buy a firm like Commonwealth, you aren't buying factory equipment or, patents. You are buying people. You're buying independent advisors, and these advisors are essentially free agents. They can choose to stay, or they can take their book of business and leave.
Right. It's not like buying a software company where the code just stays on your servers. If the advisors leave, the assets leave with them, and you just paid billions for an empty shell.
Precisely. So management has reiterated their goal to retain about 90% of client assets from Commonwealth. That 90% is the magic number they built all their financial models on.
That's the target. But what's the reality right now? Because I've seen some headlines and, frankly, some rumors about advisors hitting the exits.
The reality, and credit to management, they were pretty transparent about this on the call, is that currently signed agreements represent the low 80% range of assets.
Oof. So there is a gap. They need 90 and they have low 80s.
Correct. There is a gap between what they have locked in and what they've promised Wall Street. And the market hates uncertainty. If you're an investor, you're looking at that gap and you're wondering, are they going to miss the mark? What happens if retention drops to 70%? The deal economics look very different then.
But LPL management didn't seem panicked on the call. They had a specific defense for this, didn't they?
Oh, they push back hard. Their argument is essentially quality over quantity. They admitted that the headcount numbers might look noisy, meaning, yes, actual human bodies are leaving, but they claim they're keeping the right people.
The whales versus the minnows?
That's a perfect way to put it. They confirmed that the advisors who are staying are, on average, larger, faster growing, and higher producers than those who are leaving. So you might lose 10 small advisors who manage $20 million each, but if you keep that one massive team that manages $1 billion, your asset retention stays high, even if your headcount retention drops a bit.
That makes sense. It's an efficiency play. But why are these advisors even leaving in the first place? If LPL is such a powerhouse, why run?
It's usually cultural friction. Commonwealth had a very specific kind of boutique feel. LPL is, well, it's the massive corporate machine. Some advisors just don't want to be part of the Walmart of wealth management, no matter how good the tech is. They prefer a smaller shop.
And LPL knows this.
They know this, which is why they are so focused on the economics of the ones who do stay.
So when does this all actually happen? When do we know the final score on retention?
The onboarding is set for fiscal Q4 of 2026. So we are looking at a year-long runway here. It's a slow motion merge, but the prize is huge. Once this is all integrated, the deal is expected to contribute about $425 million in run rate EBITDA.
EBITDA. Let's pause there. Earnings before interest, taxes, depreciation, and amortization. Basically, the raw operational profit.
Exactly. Pure cash flow potential. And here is the key point of stability in all this. Despite interest rate cuts, despite all the retention noise, that $425 million projection hasn't budged. Management is basically planting a flag and saying, we will hit this number.
Okay, so we have the Commonwealth deal looming. But LPL is still a recruiting machine in its own right. Or, well, it usually is. There was a bit of an interesting dynamic discussed on the call about their own recruiters, something called ring fencing.
Yeah, this is a fascinating glimpse into the mechanics of the business. You have to understand why organic growth might have felt a tiny bit muted recently compared to their historic highs. LPL has this team of top-tier recruiters. Think of them like they're special forces. Their job is usually to go out into the market and poach advisors from competitors.
They're hunters.
Hunters, exactly. But recently, LPL commanded them to stop hunting. They took these top recruiters and ring-fenced them. They dedicated them solely to retaining the Commonwealth advisors.
So they pulled their best people off the street to protect the house.
They had to. It was all hands on deck to re-recruit the people they just bought. Imagine buying a sports team and then spending the first year just convincing the players not to quit. You can't spend any time scouting new rookies.
That explains the lull. But are they back to hunting now?
The pivot is happening as we speak. As that Commonwealth retention firm's up even in the low 80s, those recruiters are being released back into the wild.
I like that image. Release the recruiters. So we should expect the organic growth numbers to start picking back up.
That's the expectation. Although they did admit that January 2026 organic growth was a little slow, around 2.5% annualized.
Why the slow start to the year? Is that a worry?
I don't think so. It's a mix of things. Seasonality is always a factor. December is a slowdown, and it takes time to ramp back up in January. Plus, there's a technical dynamic with front-loaded advisory fee payments that depresses the asset number slightly in month one. It's more of an accounting quirk, not a structural problem.
Okay.
The outlook is for a ramp up in February and March.
Now, we've talked about individual advisors, but there's another piece of news that I think is even more significant long-term. They had a huge win with Prudential.
This is huge, and it really didn't get enough airtime in the mainstream press. Prudential is a legacy insurance giant. They have thousands of advisors, and they decided to partner with LPL to run their wealth management arm.
Why would a giant like Prudential do that? Why not just build their own tech?
Because building tech is hard, and compliance is incredibly expensive.
Right.
Prudential wants to sell insurance and advice. They don't want to manage the back office nightmare of clearing and custody. So they outsourced it to LPL. And the results are already in. Prudential's advisor headcount growth accelerated to 9% year-to-date after partnering with LPL.
9% growth for a legacy insurance firm. That sounds unheard of. Usually those firms are shedding advisors, not gaining them.
It is incredible. And LPL is now using that as a case study. This is their enterprise model. They can walk into other large institutions, banks, insurance companies, and say, look, we didn't just save Prudential money on back office tech, we actually helped them grow. That is a very, very powerful sales pitch.
That's a great way to frame it. The intel inside of wealth management.
Exactly. It moves LPL from just being a platform for individuals to being the operating system for the entire industry.
Okay, let's follow the money. We talked revenue, now let's talk expenses. Because in 2026, it looks like spending is going up.
It is. The expense guide for 2026 shows core G&A, that's general and administrative expenses, is expected to rise by roughly 4.5% to 7%.
Now, in this market, when a company says expenses are up, investors usually get a little twitchy. We want efficiency, not bloat. How is management framing this?
The spin is that this is an investment in automation, efficiency, and AI. They're arguing that they need to spend money now to lower the cost to serve later on. If they could use AI to answer advisor questions instead of having a call center full of people, that's a huge long-term win.
But the risk is that the market just reads this as integration bloat, right?
Exactly. The fear is that this isn't really AI investment. It's just the messy, expensive cost of digesting Commonwealth, and they're just labeling it efficiency to make it sound better. Investors are going to be watching that line item like a hawk. If expenses go up but margins don't improve later, LPL will get punished for it.
Let's talk about cash. We know wealth managers are sensitive to interest rates. The Fed has been cutting. How is that impacting LPL?
It's a headwind for sure. You have to understand the cash sweep business. When you leave cash in your brokerage account, LPL sweeps that into a bank account. They pay you a small interest rate, they earn a higher rate from the bank, and they keep the difference. That spread is almost pure profit for them.
And when the Fed cuts rates, that spread gets smaller.
Bingo. Their main insured cash account yield dropped to 3.41%, which is down about 10 basis points. And that's directly due to the rate cuts. That hits the bottom line immediately.
But what about the amount of cash? Usually when rates drop, money starts moving out of cash.
That's the surprise. Client cash balances are holding remarkably steady at $61 billion. It suggests a floor has been reached.
Meaning people aren't moving their money out anymore.
Right. The average account holds about $5,000 in cash. That's operational cash. It's money for paying bills, paying the advisor's fees, rebalancing. It's not investment cash waiting for a trade, so it's very sticky. It's holding up better than historical norms, which protects LPL's downside from those rate cuts.
Okay, here is the part I've been waiting for. The buyback. This was the little nugget that might have slipped past people who weren't listening super closely.
This was the hidden signal. And context here is crucial. Buybacks were paused. LPL had to borrow a lot of money to buy Commonwealth, so they responsibly stopped buying their own stock to manage their leverage, their debt levels.
Which is prudent. You don't want to be buying back stock on a credit card.
Exactly. Their target leverage ratio debt to earnings is around 2x. Currently, they're at 1.95x.
So they are already back in the safe zone.
They're smack in the middle of their target. And because of that, the CFO gave a very specific hint. He suggested that because they are ahead of schedule on leverage, there is an opportunity to refine the timing of resuming share repurchases.
And what was the specific phrasing he used? Did he give a date?
He didn't give a date, but he hinted it could happen maybe a quarter earlier than the original plan. The original plan was post-onboarding, so late 2026. Moving that up a full quarter is a very bullish signal.
Why is it so bullish, though? Is it just about the stock price going up?
It's about confidence. It tells you management is extremely confident in their cash flow, regardless of all the Commonwealth integration noise. It's effectively management saying, we have so much cash, we don't need to wait until the dust settles. We can start buying now.
That is a big deal. So bringing this all together into the investor context, it really feels like LPL is a story stock right now.
It's totally trading on integration execution risk. That's the fancy way of saying, can they actually pull this off? That gap between the low 80s retention number and the 90% target, that is the spread investors are watching. If they close that gap, the stock works. If they don't, it probably stalls out.
And the macro backdrop, how does that play in?
Well, wealth managers are levered to equity levels. The market is up, so their asset-based fees are up. That 36% growth in assets is just overpowering the headwinds from lower cash yields. The engine is simply too big to be slowed down by a 25 basis point rate cut.
So what are the key catalysts we need to watch for going forward?
I'd say three things. One, the periodic disclosures on Commonwealth retention. Watch that number creep from 80 up to 90. Two, any milestone updates on the conversion technology. Is it on schedule? And three, the official announcement of that resumption of the buyback program.
Okay, we've unpacked the earnings, the strategy, the risks. Now it is time for our favorite segment.
Let's do it.
This is the part of the show where we have to remind you that we are just two voices in your headphones. We are not your financial advisors. Please do your own research. This is absolutely not financial advice. But if you were a hedge fund analyst pitching a wild idea to your investment committee based on this print, what would that pitch be?
Okay, picture this. I'm standing up and I'm pitching the retention arbitrage spread.
Ooh, sounds fancy. Break it down for me.
The setup is actually pretty simple. The market is pricing LPLA as if the Commonwealth deal is going to leak assets like a sieve. They're looking at that low 80s number, and they are fearful. They think the deal is messy. But management is adamant they have kept the whales, the high producers, and they are still guiding to 90%.
So the market is pricing in failure, or at least mediocrity, while management is signaling success.
Correct. So the trade is a long call calendar spread targeting late 2026.
Okay, hold on. Long call calendar spread, that's a mouthful. Explain the mechanics. Why not just buy the stock?
Because this is a time-based play. In a calendar spread, you sell a call option that expires soon, say in the next few months, and you use that cash to buy a call option that expires much later, in late 2026. You are effectively betting that the stock might be kind of boring or flat now while all this integration noise is happening, but that it will explode higher later when the deal is done and the uncertainty is gone.
Ah, I see. So you're financing the long-term bet by selling the short-term premium.
Exactly. You're betting that the fear of advisor attrition is completely overblown. As this year progresses, LPL is going to release updates. Hey, we're at 85%. Hey, we're now at 88%. As they confirm they're closing that gap to 90%, that integration risk premium just evaporates. The stock re-rates higher because the uncertainty is gone.
And the kicker.
The kicker is the buyback. You get this added tailwind of the buyback program restarting earlier than the street expects, that little CFO whisper we talked about. You are effectively buying the fear of the headlines and selling the reality of the bottom line. By late 2026, when the deal is closed and the buybacks are flowing, you want to be holding those long-dated calls.
Buying the fear, selling the reality. I like it. Again, not financial advice, but a fascinating way to look at the data.
It's all about spotting the disconnect between what the market feels and what the balance sheet actually shows.
So to recap this deep dive, a great quarter on the numbers. Massive assets, $2.4 trillion. But all eyes are glued to the Commonwealth integration.
The scale plus platform story is totally intact. There's no doubt about that. But 2026 is a transition year. Spending goes up before the EBITDA rain falls down. You have to be willing to ride out the construction noise to enjoy the renovated house.
And keep an eye out for those buybacks. That might just be the signal that the construction is ahead of schedule. Well, that's all we have for you today on this deep dive into LPL Financial. Thanks for listening to Talk Tickers. We'll catch you on the next print. Keep your eyes on the ticker.
And stay curious.